Welcome everyone to Wealth Talk by Vivekam. We, Vivekam, have been trying to make some videos on investments, stocks, mutual funds, and general economy related topics, specifically in Telugu for the audience in AP and Telangana. And for that, we have received a tremendous response from our investors and also the investing community at large. The one request that they have requested us is try to make some content in English specifically so that a larger audience may be able to appreciate. In that regards, we wanted to kind of make an attempt to get our journey and our investment process and philosophy into the public. And we want to communicate a few thoughts that we feel are fit in some topics about the economy. So with that being said, let us actually get into the latest topics for today. What we have recently learned right now is the RBI's latest rate hike, the interest rate hike by another 50 basis points or 0.5 percentage to an interest rate of around 5.9%. So investing community at large has many questions like, is this the right time to still invest into equities, or is it the right time to move away this money and move it to maybe much more safer instruments like a fixed deposit or something else, which is usually the concern or the kind of questions that the investors get. So what kind of comments or what kind of thoughts would you allay onto that?
First thing every investor has to learn is there are two options. One is a fixed income investment option. Another is a variable investment option. Both of them are, can they be considered as substitute to each other? No, it is not a correct system. What you need to understand is what you are considering as a variable investment option like equities and mutual funds, and you consider them to be risky because the returns are not fixed in nature. In fact, if you take a longer period of time frame of 8 years, 9 years, or 10 years time, the returns are much more predictable in variable investment avenues, and the returns are much larger than the comparable fixed investment options. For example, in our study, what we had done was right from 1980 to 2022, we conducted a study where if somebody has invested a lakh of rupees and rolled his money into the fixed deposits every year after year, till 2022, how much was the average return earned by him? And it gave us a return of only 8.45%, because some points of time the returns were only 6%. Sometimes of some points of time the returns fixed deposit interest was almost like 12-13% also. But the average return, compounded annual growth rate earned on fixed income option, was only 8.45%. Vis-a-vis that, we also checked how much would have been the return if somebody invested in Sensex and continued to hold that investment for the last 20 or 30 or 40 years. And surprisingly, we realized that the Sensex could have given him a return of 15%. So if you look at 8% year on year versus 15% year on year, the difference is huge. The amount of wealth that can be built is uncomparable. So that is the number one reason why we always consider and we always suggest long-term investment should be in equities and short-term investment should be in fixed assets. That having been said, the other thing we also wanted to see is what is the impact that the latest RBI interest rate hike will have on the people's mindset and also the kind of their opinions on equity market investments. Whenever the interest rate rises, the depositors are supposed to be happy and the borrowers are supposed to be a little bit pricked and pinned. But does it really mean in the real sense? Are the banks going to pass on this 0.5% interest rate hike to the depositors from tomorrow? No. Are the banks ready to immediately transfer this 0.5% rise to the borrowers? That also is not sure. But banks, being in business of lending, they try to raise the interest rates first on the borrowers and raise the interest rate on depositors a little later, only when they see no traction being built up from depositors. So the interest rate lending will go up, on the lending will go up, but on deposits it may not go up as fast, which means you may have to wait for some more time before doing that. And another reason is it going to be good for investors or not is the main concern that many people have in their mind. Everybody thinks that if the interest rate goes up, the cost of operations of conducting the business will go up, accordingly the profits will decline, accordingly the attractiveness of equities also will go down. But contrary to that, what we must understand is many companies in India are now positioned in a way where there are no debts at all to the company and the balance sheet. That means they don't have any debt. Interest rate going up or going down will not have any impact in their operations. But at the same time, for the whole equity market put together, we have to understand in India, the most popular preference of investment is the real estate, buying a house. Many people end up buying one house, two houses, three houses for them and for their children also. And now, because of the rising input costs, because of the inflationary economy, and also because of the rising interest rates, buying a house, number one, you have to buy at a higher price. Number two, your EMIs on your loans will go up. And number three, your interest on your loan also will go up. All of them put together will probably dissuade some people from buying into the real estate at a higher price and start paying more and more money out of their disposable income. Once that kind of demand contraction happens because of these three factors, considering all these three factors together, if 5% of the amount that was intended to be going to the housing shifts from that to equity, that is equal to probably 10 times the normal cash flows that are being invested into the equity market, which means the domestic supply or support will be very strong for the equity market, which implies that equity markets are unlikely to seek lower and lower levels going forward. That is the first reason. So the interest rate hike will not have majority or kind of a serious impact on equity markets is number one. And number two is, if the RBI has raised the interest rate differential between US markets, dollar rates and the rupee rate is narrow. Instead of narrowing, it's actually broadened, which means most of the people who are outside the country, outside India, if they want to consider where to park their money in equities, they will have to look at only India, because India is slated to grow at 7%, whereas the world is slated to grow only at around 2.2%. So both the estimates are coming from international agencies. The money that is chasing equities anywhere in the world will have to get diverted to equity to some extent. So the foreign demand is coming. Indian demand also is growing up because of the rising cost of the first preferred asset of real estate. So both of them taken together, I think the demand for Indian equity will continue to be intact or go up also. So I don't expect any kind of serious fall because of recent RBI's rate hike.
Right, Mr. Prasad. With this being said, let us kind of also introduce the concept of looking at stock specific questions for our viewers. So what we usually do is people write to us both at info@vivekam.co.in or holdings@vivekam.co.in and ask their views on a particular stock. So we try to come up with, the most common asked stock and kind of give a view purely based on fundamentals like what Vivekam is based on, and give a view and also an estimate on the fair price of the stock. So we see that and compare against the current market price and identify whether it is worth it to invest into it, and it is worth it to hold it if you have already invested, or is it something that you need to get out. So with that being said and that introduction being laid, Mr. Prasad, many people have asked us about Powergrid Corporation. Is it a right time to get into Powergrid Corporation right now?
The question here is something like this. Should I get into the Powergrid means that means you are not holding the Powergrid already. But there have been many people who have already invested in Powergrid and are also asking us a question, can I continue to hold it because the price started seeking lower levels? So we have to answer both of them. Number one, as you already said, Vivekam believes in assigning a fair value based on set of declared results in the past, because the past is always frozen. It cannot be altered or changed by anybody. If we base our judgment based on purely the past known results and then give an estimate, many people believe that the future holds the key, but not the past, because there have been arguments in the investing world that future holds the key for price determination, but not the past. But we have categorically proved beyond doubt to anybody whoever visited our office or whoever interacted with us in the past, that the past holds the key. In fact, we strongly believe and are able to establish a fact that past plays a significant role in determination of the price range of any company that is listed in the Indian stock exchanges. Having said that, Powergrid Corporation, with the set of numbers that are announced, we have seen a remarkable turnaround and serious expansion of net profit margins right for the last 8 quarters, except in the latest quarter that is available as of today, that is on 2022 June, where it slightly slipped from 40% to approximately 37%, which is less than 10% margin contraction, not 10% PAT contraction. In fact, if you look at the PAT has gone up also, but the margin has little shrunk. That is the reason why we always strongly favor Powergrid. Number two is whether the recession comes. whether the inflation comes or whatever comes and goes, the consumption of power in India cannot be reduced. And the main drawback of Powergrid was it normally deals with the state governments, which are actually giving out free power to the farmers to win the votes. So because of these populist policies, most of the dues that are due to the Powergrid or the generators are mounting. And central government has taken a serious note on that. And they have instructed the state governments, if you do not clear the dues in time, you will have to pay cash and carry the power. Effectively saying that there won't be any credit available to you in the future. And after they enforce the discipline, the dues started getting realized. Once the cash flow of these companies like generation companies or distribution companies or who are dealing in transmission companies, if the cash flow improves, the margins will be better. And another thing is, this is a government controlled company where more than 50% is held by the government. And now in this inflation economy, our recession condition is also, the demand is not going to go down at all. And the margins are already at a very peak high level. And once the 2022 September quarter results are out, if margin regains that 40% again, there will be renewed demand in this equity. Now, the company seems good because of the factors that we considered or discussed. But is it worthwhile to invest now? Our system is, we always say a company is good, but is it worth investing or not is purely determined by the scope between the market price and the fair price set by our system. And for this company, we have set a fair price at 245, whereas it is trading at around 215. So the gap between these two is only around 30 rupees, or approximately around 14 or 15% of the current price. That is not attractive enough for us to consider fresh investment. But at the same time, if you're already holding a stock, you can wait for a few more days for the September results to come out. If the margin goes up, obviously the fair price will be from 240, it may go up to 280 or 300. That means the margin scope to grow will be much higher. So the people who are holding on to it should hold on, but the people who want to buy, who want to consider buying it at this level, may probably be better off waiting than jumping into this immediately.
Exactly. So with that being said, let us also try and tackle another question. The country's biggest mergers and acquisition really between HDFC and HDFC Bank. Many people have asked us, like, is it the right time to get into HDFC? And also in general, a word or note about the kind of business model that the two will have and how they can kind of make or take advantages from both entities. What would you say on that?
See, HDFC and HDFC Bank both are leaders in their own right in their domains. For example, HDFC is a leader in the housing finance and HDFC Bank is a leader in its own banking business. So in fact, there are some kind of overlapping areas where both of them also function. HDFC Bank also gives a home loan, HDFC also gives home loans. So when there are two companies enjoying the same brand lineage, obviously what happens is whenever they both come together, there will be immense advantage of economies of scale. And both these companies have been expanding margins slightly consistently for the last 10 years. So the company that has been consistently improving the PAT, improving the margins, improving the top line, everything seems to be so good and unbelievable. When both of them come together, when they brand together, the costs will come down because overlapping areas will be shortened. And obviously the cost of operations will come down. That means the margins will further expand. And in addition to this, when two large companies come together, which are already very large by their own rights, if they both come together, they probably will become the most valuable company in the Indian equity market or the second most valuable company in the equity market. When it happens, the lot of foreign investors also will try to pump the money into this company whenever they want to consider Indian equity. And these two companies together actually reflect the growing richness of the India, growing economies of the India. Now India has already become the fifth largest economy in the world and is tipped to become third largest economy in the world by 2030. Once that happens, the rising disposable income of the people will necessitate buying houses and will also necessitate more banking interest. Obviously, this augurs well for the HDFC and HDFC Bank. And the merger ratio, the kind of swap ratio of 42 for every 42 shares for every 25 shares also is very favorably considered. So I think both of them have corrected very significantly in the recent few days. Obviously, at this rate, both of them look attractive. they have about 25-30% margin from the current price based on June results itself. And now that the likely merger benefits are going to add to the margins, I am sure it will be very good, beneficial, very, very advantageous for the people to consider investing into either of them. HDFC particularly, yes, they should buy into it.
Right, Mr. Prasad. With that, let us conclude this video. I hope this session and the kind of content that we are trying to talk about is useful to the investors and useful to our viewers. So I encourage you to please ask your questions to us directly, whether it is on YouTube in the comment section or directly to us at info@vivekam.co.in, and we'll try to attempt to answer these questions, and we'll try to take the most common questions and definitely take up in the video, but all the questions will definitely be answered, whether it is through email or comment section. So we encourage you to please share this with your peer group, whoever is interested to learn more about the investing or investing community at large, and kind of get more people kind of interested into this. So we thank everyone for watching, and thank you, Mr. Prasad.